All right, all right. Good morning, Facebook family. Afternoon for those of you on the East Coast. Caleb Kid Coy here, along with my associate and brother from another mother, Mr. Christian, Sir Chris, affectionately known as Coach Chris. Chris, thanks for joining us today for this impromptu live.
Oh, thanks for inviting me, brother. Appreciate it. Thank you, Caleb.
Chris and I have the fortune of working with an organization that is really empowering people to take back control of their finances and ultimately learn how to bank like the banks do. And if you got a chance to see my post from about an hour ago, I talked about how one single book absolutely changed my perspective and ultimately set me on a path of researching international banking and the Federal Reserve. And that book was called The Creature from Jekyll Island by G. Edward Griffin. Now, what happened in Jekyll Island, Georgia, back in the 1920s, if you're not familiar, was on a scale of 1 to 10, 100. It was the epic inception of the Federal Reserve System, i.e. the international banking cartel. And so this system was created, these founders, when they came up with the idea and the plan, they knew that it would make them infinitely wealthy and that it would, allow them to retain control essentially over the money that people deposit into banks. And so if you don't already know this, you're going to want to go spend some time researching fractional reserve banking, and you'll begin to understand that the banks take about 97 cents of every dollar that you deposit, and they loan it out again, and they make profits on that spread. Well, a few of us like Chris and I decided, that's not very cool. When you're offering us, maybe 1% or 2% most these days on our checking or savings account interest, and you're putting all that difference back into your own pocketbook, is there a way that we could put that back into our own pocketbooks legally, ethically, and everything else? And the answer to that is, Chris?
Absolutely. In fact, the only thing that's new about it is regular people doing it, not banks and corporations.
Do you guys hear that? Regular, everyday people are doing it now. And the great part is not only are they learning how to do it, Chris, but there's an incredible software tied into it that helps them not only eliminate their debt, but leverage that debt like the banks do to grow their money. Can you talk to us about that for a couple minutes?
I think you're referring to what I call my assistant Max, right?
That's right.
Technically known as the Money Max account by United Financial Freedom.
Correct.
Right. So, yeah, I mean, that's kind of how I got started with this. I came in from a different perspective than this banking perspective you're talking about.
Mhm.
And I've come to understand and know and love the banking thing. And that's really what we're here to talk about. But down at the local bank, of course, they use computers and specifically artificial intelligence in order to not just manage data like in a database, but to actually make decisions about what kind of transactions to make, where to put money, when to move it, from what account to what account. And then the key concept here, if people are taking notes, is the terms and conditions. So you referenced the fractional reserve banking system and the requirement, the very tiny requirement, in fact, for a 3% cash reserve. If you think about it, the reserve should be extraordinarily higher than that. That's the whole fractional reserve thing, right?
Mm-hmm.
But in any case, that's a slightly different topic because we don't want to just sit here and whine about the international banksters. We want a piece of the pie, right?
Right.
And the folks who are listening on Facebook right now want a piece of the pie. So give us a thumbs up or something if you're with that, if you want to learn how to be your own bank. Okay. So you can't really be your own bank if you don't have an operating system like they have at a modern bank based on artificial intelligence. And so mine is what Caleb just asked me about. It's called the Money Max. And just for short, I just call it Max. And I like to think of mine as like some 25-year-old recent graduate of some Ivy League school who crunches my numbers. Okay. So I took over my mom's mortgage when my dad passed away. And I'm trying to pay that off to keep the house in our family. And I've got a little credit card debt. And I use this program, and it basically is a 4-step process. So again, if you're taking notes here, it's a simple 4-step process. Number one is you're going to pay your bills the way you always have. So let's dive into that just a little bit. That means it's not, we're talking about debt reduction or debt elimination. And I did not say debt consolidation or refi.
Thank you for
Because
that.
sometimes people accidentally hear refi or consolidation. We're not talking about any kind of loan officer type thing, any kind of like new loan to consolidate debt. That's not what we're talking about. In fact, Caleb, I'm going to give my classic example here. And you've probably heard me do this before, but just play along with me with this. So Caleb, let's just pretend that you and your lovely wife just bought a brand new house, maybe in South Carolina or something. Okay. And you were so excited about it that you stopped at a gas station or something on your way back from making your deposit, and you bought a lottery ticket and you won the lottery and you paid off the house. Woo, woo, right? Now, we don't actually have any helpful advice about winning the lottery here, but in that crazy scenario, if that happened and you paid off your house right away, would you pay any interest, assuming no prepayment penalties?
No, sir, I don't believe I would.
So if you had any extra discretionary income, or if anybody had any extra discretionary income and they use that to get out of debt faster, it should make sense that we can get out of debt faster. If anybody's ever heard of Dave Ramsey, give us a thumbs up in the chat if you've ever heard the name Dave Ramsey. I bet a few people out there have. But if you go to one of those, whether it's at church or anywhere else, if you go to a Dave Ramsey class, this is what they're talking about. If you prepay, and or even if you haven't heard of that, if you've heard of bi-monthly payments at the bank or anything like that, making a prepayment does get you out of debt a little bit faster. For the record, the bi-weekly thing, it's like spitting in the ocean though. It's not much. It's like a match on a fire, a push on a shove. You feeling my blue on black references there, Caleb?
I'm feeling it right there, bro.
It don't mean much, but if we do have a little bit more where we have what we're really looking for this program to work, to be completely transparent, is about $200 of discretionary income minimum after you've paid off your bills. So I'm still on point one. You pay your bills the way you always have.
Okay.
Nothing's taking over anything. You're using the checking account you always have, the direct deposit you always have. Point number two, any extras that you're used to buying that aren't just like automatic on your budget, you keep doing. Our program is not about quote beans and rice or belt tightening.
Okay.
If you got to do cool stuff with your kids, or if you like to play tennis, or if you can't resist buying a McKinnon sweater because you're excited the Avalanche won the, live your life, right?
Yep. So and no changes to our spending habits, correct, Chris?
Bottom line,
that.
Caleb. Yep. And not just that, but nobody's taken over anything. We're paying our bills the way we always have, right?
Yep.
And so if we've done those two things and there's some money left over at the end of the month, then we've got something to talk about. Now, if you're listening to this concept and you don't have any money left over at the end of the month, I never said that this program was for everybody. It's not. It's for qualified people. Okay.
Yep.
So, and if you're not quite in that situation and you're trying to get cash flow positive, there's a whole separate seminar that talked to Caleb about a part-time job opportunity and a side hustle. He's got a couple good ones. Okay.
There you go.
But that's not really what we're here to talk about. Okay. So assuming that you've already got at least maybe 200 or maybe a lot more discretionary income, the third step in the process is to put that into an offset account. Okay. Now, the simplest offset account would be a savings account at the old-fashioned regular bank, a plain Jane savings account.
Right.
The other thing that we could do is we could use an open-ended line of credit. And if people want to do a little Google search, they can look up velocity banking. And I'm going to define velocity banking right now. Velocity banking is using an open-ended line of credit, the most common one being a credit card.
Yep.
Or any other line of credit. to pay off a closed-end loan, the most common one being a mortgage, but we're also talking about student loans, car loans, basically anything with the word loan in it, Caleb, basically. So
Pretty much, yeah, pretty much.
yep, that's pretty much closed-end loan. So if whether we're using a savings account or a open-ended line of credit as our offset account, then we'd still be able to put that excess money in the offset account. That's the basic. But when we start talking about open-ended lines of credit, and this is kind of an obvious question, Caleb, but if you could pay back a loan or not pay back a loan, like which one would you prefer?
It's a little tough, but I'm probably not going to pay it back if I don't have to, and it's not going to adversely affect my credit score.
Thank you. That's the key thing, right? Because as long as it's not going to affect your credit score, as long as there's no recourse, then it ain't your daddy's loan. So back to the terms and conditions and what we're talking about, what banks do, and back to the definition of the fractional reserve system where they have that 3% that they have to have as their cash reserve. Caleb, I personally, a year ago, I did not know where banks kept most of their cash reserve.
Mm-mm-mm.
I'm guessing that, and you might have because of your research with, like you were talking about, with the book. So you might have already known that, but myself personally, I did not know that a year ago. I knew the 3% thing, but I didn't know where they kept it. Now, what I learned from our friend David Weiner is that the banks keep billions and billions of dollars, basically all of their cash reserve, in life insurance products.
Boom. Is that a shock to anybody out there? Hey,
Yeah, somebody
Denise,
gave us a whoa face, right?
Yeah,
That's
I was going to say,
right?
Denise
Yeah.
probably knew that already. Denise Kramer's with us, but yeah, some of you guys probably did not know that. So go ahead, Chris.
And so, well, that begs the question, why in the heck would banks be putting their reserves in like life insurance? Like that's kind of the obvious question, right? And it's back to what I've been talking about the terms and conditions of loans. So just really obviously, and we were kind of joking around about this, but let's just spell it out a little more properly. On a normal loan, you have to apply for it. You could be approved or declined depending on your credit worthiness. Assuming you're approved for it, you have to make your payments, obviously. You have to make them on time. And if you don't do that, your credit score is going to go down. And if you don't make the payments at all for long enough, you could actually lose the entire loan. And a lot of people, I'm guessing that there's at least one person out there in our audience right now who needs to hear this. And this is actually a terrible thing about the way our current laws are set up. But if you default on a loan, you could also end up owing taxes on that because it's declared as income. In fact, it's very likely you're going to end up owing taxes on that. So that's literally kicking them while they're down. And it's pretty disgusting in my opinion, but just, it is what it is. So with those kind of terms and conditions, if we could have basically all the opposite of that, that'd be a little bit better. And so this is answering the question about why banks are putting their reserves and have been for a long time. Long time, forever, basically for as long as insurance companies and banks have been around in America. Okay. And the rest of the world too, but we're really talking about the American banking system today. Okay. So it's not just banks either, is it, Caleb?
It's not.
If we can go look this up as well. Corporations keep cash reserves. So, and by the way, just a little bit of someone out there is anyone wondering, like, how can a bank even buy life insurance? I should probably address that a little bit.
Yeah, I think that's a great question, and then wrap around because Denise Kramer here said she's one of those people that doesn't have debt, but she's got passive income. So we'll address that too.
Well, that's a simple answer. You don't need debt for anything we're talking about to work. You can still set up your own bank. If you happen to have debt, the debt becomes the seed money for your bank. So the money that you're going to use to prepay your debt becomes the seed. And then when you pay off your debts faster, the money you were paying on debt is like the water that nurtures that seed. And in time, with stock market growth and bonds, that seed can grow into a tree that's going to provide you shade and comfort in retirement or at any point in your financial freedom journey. Okay. And that's really what being a bank's about. Now, if we don't have debt, that's fine. We can just skip that part kind of. We can actually kind of hit fast forward because we're not trying to get out of debt first.
Right.
Okay. So great question, Denise. But back to the, just to wrap up the point, and I'll be quick about this, but a corporation can't just go buy life insurance on itself because a corporation, hello, can't die. Hello, it's kind of the definition of a corporation, right?
Right.
But individual employees can and do, and we're not talking about your everyday employee. Like I just got off the phone in the last hour with my best friend, Bobby, who I've known since I was 5 years old, who works for Frito-Lay. Love him to death. I have all the respect in the world for him, but he's busy as could be this weekend putting up chips for y'all in the Cincinnati area for Frito-Lay, okay? But all due respect to my best friend, we're not talking about that kind of employee at companies like Frito-Lay. We're not even talking about his boss or the boss above that. We're talking about like their key executive people at Frito-Lay or Panera or Starbucks or General Electric, or just about any company you want to mention. Caleb, you know the biggest the corporation that does it more than anybody, I believe. They own the Denver Broncos.
Oh, those guys.
Good old Walmart. And by the way, while we're talking about corporations and life insurance, J.C. Penney would have gone bankrupt in its cradle if Mr. Penny had not been able to take a loan against his cash value life insurance policy. And Mr. Walt Disney of Mickey Mouse fame and all the rest of it also got his company started by using cash value life insurance. So when we're talking about creating our own bank, I very much doubt that people came here expecting to hear about life insurance, but that's actually what we're talking about. Now, the big problem with life insurance is you have to pay for life insurance. You do. That means you have to pass
pay
the
for
health check.
most insurance, Chris?
For any, yep, pretty much. And you know, the thing is, with life insurance, if you have a permanent policy, there's 100% chance you're going to end up getting paid on it with a permanent policy. Unlike a health insurance or car insurance policy where you buy it hoping to never use it.
Right. Yep.
Right.
Great point.
But if you have a permanent life insurance policy, there's 100% chance, for obvious reasons, that you're going to end up using it if it's a permanent policy. Okay. But in the meantime, we can also use it for all kinds of living benefits. And I'm not talking about critical or chronic or terminal coverage right now. I'm talking about taking money out as loans, which is what Walt Disney did, which is what J.C. Penney did. It's what Panera Corporation does, Starbucks, on and on and on. Okay. Not to mention Bank of America, Wells Fargo, and every other bank you've ever heard of.
There you go.
Okay. So I call it an installed personal bank. So for myself, I've been using my bank for about 18 months, Caleb. And the first 12 months, I let everything sit still. So getting back to my 4 points, we have to have that discretionary income and we have to put it into really any kind of offset account. And you could use that to get out of debt faster. Now, if we're talking about the fourth point here, this is where it doesn't matter whether we have debt or not, because after 12 months, I started taking money out as loans. Now, the reason I left it there for 12 months is only because I wanted to earn money on it first before I started taking loans.
Okay, because you're actually talking about a liquid bank account here, aren't we? Just like any other bank account. If I
truly needed that money, I could have taken it earlier. And in fact, there was actually a point in that 12 months where I did dip into it a little bit. And it wasn't ideal because I took a negative arbitrage loan for that small amount that I took. But after I got credited the first year, because I earn interest, I suppose I should touch on this for a second, because some people out there might not know about indexing when it comes to like life insurance or annuities. I'm sure everybody's heard of indexing when it comes to mutual funds. And on an indexed mutual fund, you can make money or lose money depending on the stock market. But on the indexing I'm talking about in an insurance product, you can only get a zero or make money. You can't lose money. Okay. So for my account, I waited and got my crediting for the first year, and then I started taking loans. And so I've put in some money to fund the cost of the insurance for my $450,000 of death benefit to protect my family. And for that point, it's just like any other life insurance policy with a great company, critical and chronic benefits, yada, yada. but I've taken about 25,000 in loans against that. Now, obviously, since it's a loan, Caleb, how much did I owe on taxes for those 25,000 in loans?
Typically you would have owed a chunk, but now you don't owe anything.
That'd be a big old zero.
Yep.
And if people want to read a great book about that, it's The Power of Zero by David McBride. There's the New Rules for Retirement. There's a bunch of great stuff out there about this concept that's been written. And so this really isn't new. It's been written into the Internal Revenue Code, the one published by the Internal Revenue Service. So in that
Those
IRC,
guys that just hired like 87,000 more employees there, Chris?
those guys, yeah,
Okay.
those guys, right.
Sure.
Yeah, precisely. And so they've got this rule book, like a lot of organizations. And in section 7702, or pardon me, in 7702 of that code, section 101A is where it has said for generations that anybody anywhere who owns an insurance policy can take loans on it. So if I'm Walmart, and I happen to know, because I'm a Broncos fan, the names of the Walmart people now, which I didn't a few months ago. But Rob Walton's the chairman of the board, and his son-in-law, Greg Penner, is the CEO. And his daughter is on the board of directors. The type of people they would be buying policies on is like Greg Penner and Kerry Walton, or Kerry Walton Penner, I should probably say. And those type of people, not my buddy Bobby putting up chips on the shelf so that we can all, have a nice Labor Day. Okay. So key employees at the bank or corporations are used by the corporations, and they buy that policy on them. But Caleb, let's say that you were one of those key employees at Walmart or something. You should be so lucky, right? But they bought the policy on you, but you quit or move to a different company or retire. Something happens where you leave Walmart before you die. Your wife was never the beneficiary of that policy. Walmart was, or Bank of America was, or Wells Fargo. So anyway, not to put too fine a point on it, but that's how they get the money into it. Okay. That's how they keep their cash reserves there. And then eventually the banks collect on those policies as well. But that's not even really the point. The point is they're able to put money in and then take it out. So the other issue with life insurance, other than you have to qualify for life insurance and you have to have a human being who can die, okay, aside from that little wrinkle, the other issue is typically in a life insurance contract that's sold to you by something called a life insurance agent. And I've never yet, Caleb, have you ever met any life insurance agents who worked as volunteers? I haven't.
No.
But they usually want to get paid, okay? And so insurance companies, in order to pay life insurance agents, put on this little nasty thing called a surrender charge. And if you go Google life insurance, depending on the type of life insurance you're looking at, but this applies to all life insurance, any life insurance anywhere, there's usually something called a surrender charge. But they they being insurance companies, created this little thing called a rider, or something you add to a policy, right? And it's a waiver of the surrender charge. And they've been doing this for banks and corporations and businesses. And there's actually a fair number of companies out there right now that waive that surrender charge if you're a business or a bank. That's been around for a long time. But Caleb, I only know one company.
Being the conditional word, right, Chris?
If you're a bank or a business. But I bet there's a lot of people who are listening to us right now who might not have a business set up. And even if they did, they might prefer to just buy the policy on themselves. So there's only one company that I know, the one that I own my policy with that I was referencing earlier, that allows somebody who's just an individual human, not a bank or a business, to get that same waiver. And I'm not going to even say the name of that company right now because I don't know who's listening to this. But if people want to find out about that, they need to come have a meeting with you or me.
Yep, that's correct. And guys, I put a link in the chat, calebkidcoy.com/build my bank. You're going to register for an amazing free webinar that you can watch at your convenience that will detail and break this down to you. And we're talking about a company that's been around not since the early 1900s, but the mid 1800s. Old, old as the banks, right, Chris?
Well, depending on the bank you're talking about, but
Yeah,
before the time of Lincoln.
there you go.
We're also talking about a company that has the highest out of 22 possible objective ratings by the rating companies. We're also talking about a company that is one of only 5 companies in America with positive forward guidance on that perfect rating.
Mm-mm-mm. I dig it. So guys, are you starting to, yeah, Denise gave us the wow face. Yeah. Are you starting to see, like, again, I should have gave this caveat at the beginning, Chris. We're not talking about a cryptocurrency investment. We're not talking about Forex or trading. We're talking about doing exactly what the banks do with legitimate insurance policies.
Yep.
But yes, there's a neat trick and strategy to it. We're hinting toward it, but you go and watch that webinar. It lays it out in detail. It isn't going to cost you anything but 45 minutes of your time. Like, what else you got going on this weekend other than, maybe partying and barbecuing and all that fun family stuff or whatever, but like 45 minutes that could transform your life and change your financial trajectory and future, especially right now, guys. Anybody notice prices going up, gas, market, all that fun stuff, little thing called inflation, little thing called economic volatility. There's a lot happening in our world right now that is dismantling our peace of mind, if you will. And it will continue to do so unless we position ourselves in a way to get ahead of the curve. And Chris, I don't know about you, but there's not too many ways to do that without taking a major risk. Yeah, you can go play the markets. Yeah, you can invest in crypto. I do too, but I also realize that there's a major risks there. Trading, things like that, all risk involved. This is not the same as that type of risk. This is something secure. Like Chris said, he gave all the credentials for this company, and with the addition of technology and artificial intelligence that is basically running anything and everything in our world now, right? You're on your computer, you're on your smartphone. It's there, guys, but it's allowing us as everyday folks to be empowered to do what the big dog bankers could only do themselves before. So this is game changer. We encourage.
Do we have time for me to touch on two things that are on my mind?
Yes, and let's kind of we'll go there, and then we'll kind of wrap up from there today, Chris. And guys, we're going to do this again, and we'll kind of continue the conversation.
So first, just very briefly, I just want to say who the presenter is of that workshop you were talking about.
Okay.
Everything that I've been saying was basically quoting from that workshop, from me having watched that workshop, like, I don't know, somewhere around 100 times by showing it to people and watching it with people. Okay.
Yes.
So the person who's speaking there, I'm not actually biologically related to in any way. Okay, just to be clear, but I do call him my Uncle Dave. And I got to just give a very quick backstory here. I've been with him for creeping up on 5 years now. And I've been an insurance agent for 22 years. And skipping through a whole bunch of stuff. I did a whole bunch of things in my career that I'm not even going to get into right now. If you want to know, you can go look me up on LinkedIn. That's all laid out pretty well right there. But I'd done my whole career, and I'd been in management and closing sales and yada, yada, and all kind of stuff. And then I met Dave. And so what I'm trying to say is that Dave is the smartest, hardest working person that I've ever met in the insurance industry. And that's why I followed him in the first place. And it took me about a year to figure out this other part that's even more important than that. And that's that he is the most ethical and caring person that I've ever met in the insurance industry. So I just wanted you to know who Dave Weiner is, who's doing the presentation. And he's just got a heart of gold and a big old brain. And that's the kind of person you want on that wall for you.
Yeah, 100%.
So he does break it down great. And I'm trying to think now, what was the other thing? Oh, yeah. Just to talk for just a quick second about the underlying mechanisms with the accounts. Okay. So one option that we didn't really touch on that I would be very remiss to not mention is there's just a guaranteed option. Right now it pays 3.75. And right now I'm taking my loans at 3%. And Dave Wayner, who I was just talking about, has demonstrated that even at a 33 basis point return, then I can still do incredible things with being able to wash money through this. So if I want to play it real conservative, I can take a guaranteed 75 basis points right now. Caleb, is there any chance interest rates are going to go up soon? I mean, we're not making any predictions here, but maybe.
Probably likely.
A lot of people out there think maybe, right? I mean, and I'm not going to disagree with the people who are saying maybe likely. Okay.
Yep.
I saw a thing just this morning on Reddit, and that it was random people on Reddit, not scientific, but they were asked to pick how likely basis point increase would be at the next Fed Reserve meeting coming up. And I think it was like 24% of people thought there wouldn't be an increase. And obviously the rest thought there would be an increase of either 50 or 75 basis points.
Ooh.
I mean, that's just random opinions out there. But what I'm getting at is if it's at 3.75 right now, what if it goes up to 5 and I can still borrow my money at 3? In fact, I didn't mention this, but there's a limit on for when I borrow my money. It is a loan. I do have to pay for that loan. Right now it's at 3%. The max it could ever be is 5. Caleb, you remember, I mean, actually, you're not old enough to actually remember, but you're a student of history. In the late 70s and the early 80s, what were CDs paying into the double digits, right?
You're right. High.
I'm not making any predictions or anything, but even if it only went up to like 6%, never mind 10 or 12 or anything, and even if my borrowing rate went up to 5 and I can get a guaranteed 6, I might have to grab that, right?
Yeah.
Now, the
kind of
other
no-brainer.
option that we have available is there's just like with indexed mutual funds, there's stuff that's linked to the S&P 500 that people have heard of. I'm not a real big fan of those just because I don't think they're as good as what I'm about to say. They still work pretty good, but I just don't think they're as good as having the professionals at Credit Suisse manage your money for no fee. I mean, not from you. They're getting paid by the company that I'm not going to reveal in this webinar. Go talk to Caleb.
I love it, Chris. So one last thing, go back to that final point, number 4, and just reiterate that one last time for us.
30-second recap of the 4 points.
30-second recap.
Get paid, pay your bills the way you always have. Live your life the way you always have with any extra stuff. Take your excess money and put it into some kind of offset account, preferably your own bank that you can take loans against.
Preferably.
Point number 4, and this is the biggie, starting in month 12, party on. Keep your cash reserve in there, just like the banks. Run your bank, take loans out of it all day, every day, right down to the nub of your cash reserve. You put money in, you take it out. It takes about 2 weeks from the time you put the money in. There's banking rules about it has to settle for 10 days and stuff like that. But as soon as your money settles, you can request it right back out. And we recommend waiting 12 months to do that, even though you could. We really don't recommend doing it in the first 12 months because you want to earn interest first. Otherwise, you're taking an old-fashioned loan.
And then the software and your amazing advisors and the team that we work with are going to show you exactly how to do that. 4 key points, kind of like live long and prosper Vulcan thing going on there, Star Trek sci-fi. But anyway, guys, you need to go and watch this webinar. Did you hear how many times Chris said he's watched it? Every time I watch it, I learned something new. But you're going to get to see in detail how the software functions, how this works, and it will change. If you have an open mind, I mean, if you have an open mind, conditional, it will change your mindset. It will change your perspective on money and finance, and you will recognize that this is an opportunity that you need to transition into right away. So with that said, I've got to get rocking and rolling here, Chris. Really appreciate the time. Some great juicy nuggets in here. Denise, thanks for joining us there in the chat and commenting. CalebKidcoy.com. Kid with 2 Ds /build my bank to register for that free webinar. You can take 45 minutes on this holiday weekend and empower yourself and your future financial legacy. And of course, at calebkidcoy.com, lots of information on building your legacy, protecting your estate with a properly drafted revocable living trust, and so much more. So Chris and I look forward to the possibility of working from you and hearing back from you when you check out that webinar. Have a safe and blessed holiday weekend, everybody, and we'll talk to you soon. Later, Chris.